Welcome to Manufacturing Talks with Jim Vinosky. Industry has a million cool stories, and Jim talks to the movers and shakers who are making them happen. Let's dive in.
Hey everybody, welcome back to Manufacturing Talks. I'm Jim Vinosky, your host, and I'm really glad to be joined today by Peter McDonald. He is founding partner at his own company, McDonald Strategy Partners. And I've admired his work on analyzing companies near and dear to both our hearts for a long time. So welcome, Peter.
Yeah, thanks, Jim. Great to be with you.
Yeah, great to have you here. Your posts on LinkedIn are always extremely educational, so I appreciate that. Why don't you tell us?
I'm happy to hear it, yeah.
Yeah, absolutely. Not everything on LinkedIn is that way, so thank you for that. Before we get rolling on the content, why don't you just tell us about yourself, how you got doing what you're doing today?
Yeah, well, let's see. I guess I'd say I'm on my third career right now, which is as a strategic planning consultant. We do a lot of, we help a lot of kind of small to mid-sized companies that are really putting together their first formal strategic plan. And I've been doing this for about 7 years now. Prior to that, I was at General Mills for a little over 20 years and joined the company as a brand marketer. And that was a good chunk of my experience at the company. But I did probably spend about, over a third of my career was in some variation of corporate strategy and M&A, including running corporate strategy the last 6 years I was with the company. So a lot of, kind of CPG experience and in particularly the food industry. And then my first career was actually in government. I was a political science undergraduate major and had interest in government. And I went to work for the state in Boston, Massachusetts, which is where I grew up in Massachusetts. And I worked for 5 years, a couple of years in the legislature, and then 3 years for the governor. And then at that point, I decided it was time to make a switch. So that's a little bit about my background.
Yeah, and it's really fascinating. I saw that about the government thing and kind of wondering how you went from here to there. So got that. And then interestingly enough, you and I started at General Mills the same year.
Oh, is that right? I guess I didn't realize that. Go class of '96.
Yep.
Right.
I was way far away. I started at the Reed City Yoplait plant.
Okay. Yeah. Okay. Yeah. I started in the meals division at the time. So in Minneapolis, I had only been to Minneapolis one other time, but it was a great city. I really enjoyed being there.
Yeah, and I saw you had some projects with the Pillsbury acquisition as well.
That was my kind of first kind of stint in the world of corporate development at the time, but kind of strategy and M&A. I went there fairly early in my career. I'd only been with the company for maybe 5 years, but I had an interest in that area, and so I kind of lobbied to go get an experience there. And as it happened, we were acquiring the Pillsbury company at the time, so I got to kind of work on that and see that up close and personal. So
well, that was a biggie, obviously.
It was a biggie. Yeah, it was.
I got a little taste of that. I was on the team with the Mountain High Yogurt acquisition.
Oh yeah, okay.
And then also did a whole analysis of kind of the manufacturing end for the Yoplait division on what was out there back in the late first decade of the 2000s that we might look at snapping up. Yeah, that's cool stuff.
Yeah, it is interesting. I enjoyed that, and I think that experience in corporate, a lot of, in consumer products, marketers are kind of, it's a dual responsibility function. You're primarily responsible for demand generating activities like marketers are everywhere.
Yep.
But you also are the general manager for the business and responsible for delivering the P&L, and that makes it a kind of a unique training ground. But one of the things that I found really interesting about, about being in corporate was just the exposure to, thinking about the balance sheet, thinking about cash flows, thinking about, capital allocation and some of those more corporate topics that, even as a kind of a brand manager, P&L owner, you're not exposed to that kind of stuff typically, other than your sort of exposure to decision making from the corporate center that is factoring those things in that you often don't have visibility to and understand. And so it was actually a really great developmental experience for me to go and do that.
Yeah. I got a little taste of that when I worked on the business teams in my stint in Minneapolis. And it's interesting now to, tracking your posts on LinkedIn and seeing so many of the marketing managers who I worked with chiming in on what you have to say.
Yeah. Yes.
Good stuff.
Yeah.
Go ahead.
Well, I was just going to say, there's a lot of former General Mills folks out there doing great things, in the industry. And so LinkedIn is a nice place to see old friends.
Yeah. And it's a great community. I mean, you said it in one of your recent posts about the strength of the folks who are there and the folks who've moved on.
Yeah. Yeah.
I couldn't agree more. So you became certainly an expert on at least certain elements of the CPG world. And that's what I value so much. Obviously, that's where I've spent a lot of my career. So just looking at that, what is your kind of 10,000 foot level assessment right now of CPGs?
Well, it's kind of a tale of two cities, isn't it? I mean, you sort of have these big legacy companies that, not in every case, but as a collective, really struggling, and have been struggling, for a bit, and I would even say, like the pandemic was sort of an odd tailwind for some of these companies, but that was really an interlude. That was a positive interlude, that was an interruption of a longer term trend of underperformance by many of these companies for many years. And so then you've got all of these really dynamic, growing, emerging brands out there that that are driving the growth and stealing share, and and really being successful and really being the innovators in the space. And so it's an interesting dynamic, and there are lots of reasons why that has developed. But that's kind of that's the big macro. That's the big macro on the industry right now.
What do you think, like the top one or two reasons for the malaise would be right now?
Well, I think it's a combination of some structural issues that are very real, and some, I guess I'd call them company, but they're widespread across many companies. And so the structural issues, the first structural issue is population growth, which has decelerated pretty dramatically in every developed market. Right. And the underlying drivers of this industry historically have been certainly for food, but also for non-food categories. Population, just more people to serve. And then the second is household income growth. And those two contributors are actually pretty formulaic. Like if you look across markets, you tend to see an underlying growth rate for the industry that is, that is basically population growth plus some percentage of household income growth that is less than 1, because people don't increase the percent of their income that they're spending on food or, toothpaste or soap or whatever it is. So it's always something less than household income growth, and the population growth part of that has decelerated. I don't have the global figure off the top of my head, but in the U.S., it's population growth in the 20th century was 1.34%, something like that. It's half that now. Over the last over the last decade, it's dropped in half, and that's
some markets are going backwards.
Exactly. I mean, you look at Italy, you look at Japan, particularly Southern Europe. There's a lot of population contraction going on, and so that's tough because you just have there's just less natural growth available in the industry.
Yeah.
Household income, particularly in food inflation really outstripped household income growth during the post-pandemic inflation spike, and that also was a headwind for the industry. And they're continuing to feel that headwind because I don't think that sort of balance has returned. There are some observers of the industry who believe that is more systemic and long-lasting, and that may be the case. And what they'll say is, when inflation spiked and brands were taking a lot of pricing, private label grew, which is true. The price gap, anytime the price gap to the brand, expands past a certain point, you see private label surge, and you see that in past, economic disruptions.
Yep.
What some people are arguing is that this is going to be more of a permanent shift, and that may be true. I'm taking more of a wait and see attitude on that, because if it is permanent, it would be a departure from history. Usually on the back end, kind of brands get the price umbrella right. They sort of recover a little bit. Private label retains a little bit of what they gained, but they don't retain the whole thing. So that's another, at least a current headwind. The third, which kind of takes me back to this observation about the haves and the have-nots, or the tale of two cities metaphor, is innovation. The big companies just are not the source of meaningful innovation in the industry anymore. And that's kind of their own fault.
Yep.
It's also not something that is easy to turn around, because it's really a case of muscles that have atrophied through lack of use, and it's very hard to rebuild that. It's if you have diminished your innovation capacity by the choices that you've made over a relatively long period of time, you can't just turn on a dime and crank that up again. And so that's a real struggle. So, to be honest, I'm not super constructive on the big companies right now, because they've got structural headwinds that they can't do anything about.
Yep.
And they've got kind of self-inflicted problems as a consequence of, what I would say is a deprioritization of big innovation over, a fairly extended period of time.
Right. Bit of a vicious circle on innovation too. I mean, Clayton Christensen nailed it as far as what I experienced in Yoplait is we weren't going to do any innovation that was going to threaten Core Cup, our main products with the cup, right?
Yeah, exactly. You sort of have two things, and I mean, the innovator's dilemma is something that I have referenced before.
Yep.
In some of my writing, you have two things that are happening. One is you do have a very strong bias aversion to disrupting yourself. And that's a lot of what he talks about in his writing, is this idea that, the incumbent has a disincentive to disrupt a category and industry that they are the beneficiary of. That's very true, and that's exactly what you're talking about. The other thing that you find in these companies is, one of their great strengths is the ability to optimize things that have a strong market position. Mm-hmm. And when I say optimize, what I mean is to manage costs, to drive out costs, to maximize return from investment spending, whether that's capital spending or it's SG&A spending on capabilities or marketing levers or whatever it is. They're
Yep.
really excellent at optimizing. When something is optimized, it is highly profitable, and it becomes very difficult for innovation to meet the financial expectations of an optimized organization. And so that's the other barrier to innovation, is that, and if you look at these emerging brands that are driving all the innovation, they're not profitable in many cases.
Yep.
But they're driving growth because
Right.
they're finding those needs that the big brands aren't meeting. They're following the consumer as they change and evolve, and they're getting the revenue, and they've got financial backing, mostly VC financial backing, that's perfectly happy to run a break-even model that is all about a growth trajectory with kind of a payday on the back end when they sell to somebody who needs the growth.
Yep. Yep. Isn't there a bit of a potential own goal with that extreme optimization around? I mean, look at spend a
Totally.
lot of time in Big G as well, and I look at cereal today, and there's not a lot of gap anymore quality wise
Yeah.
between the name brand cereals and private label.
Yeah, right. And I think that's part of the, kind of back to this argument that, hey, all the pricing that everybody took that kind of created this opening for private label was, creating an opening for a competitor who, in many cases really had closed the quality gap.
Yep.
And the central argument for that case is there's no daylight. There's no daylight between the name brand and the private label. And so this kind of this inflation period where private label really surged isn't going to result in a reversal even when the brands get that price gap back to historical, because you've got a whole bunch of consumers who come in, experience the product that's, hey, just as good as the name brand. And why would they go back?
Yep.
And again, I don't know enough to say whether that hypothesis is going to prove out or not, but there's certainly a strong argument there that could be the case.
Yep. Yeah. And you've mentioned a couple of times there's winners and losers here. I think a lot of us tend to fall in the trap of seeing CPGs as this, common monolith, all marching in the same direction, but that's not entirely the case. So
No.
who are like the one or two big winners and losers right now, and why is that so?
Well, I mean, the companies that that are at the top of the league table. I mean, Coca-Cola probably is. I mean, they're the one that I look at. I'm like, wow, how are they doing that? I mean, I should probably dig in and understand it a little bit better. But you look at them, and they have really performed well. And what I look at when I say that is the kind of decomp of their top line performance. And what I'm looking for there is, are they growing units and price at the same time? The companies that win in this space are able to do that consistently. And Coca-Cola is, and I give them a lot of credit. A couple of other companies in the space that I think are, performing decently. Unilever, I'd say, is also doing pretty well. They have had some good performance, and I would mention Nestle as well. I wouldn't say they're quite as strong, but they have a new CEO. I think he's got a very kind of back to basics view, and they have performed at expectation, and they seem to be really getting their feet under them and heading in the right direction. At the bottom, you kind of have Kraft Heinz, ConAgra, and sadly General Mills.
Yep.
If you look at, one of the things that certainly characterizes, the top and the bottom. The top, you can see that those companies are much more global. They've got very strong emerging market exposure, and they have had that for a long time, and they know how to operate in those markets. Those are markets that aren't quite as don't have quite the same headwinds in terms of population growth and household income growth that that the developed markets have. If you look at the bottom group, you've got a lot more developed market exposure and a lot more U.S. exposure.
Right.
And of course that's just kind of the environment that they're operating in. There's there, I'm sure, are executional differences between the top and the bottom as well. But but the exposure, the natural growth exposure, is certainly part of the explanation.
Let's talk more about Coke, because that's one that intrigues me in a certain way, and that is they got rid of a bunch of their manufacturing, right?
Mm-hmm.
Let's talk a little bit about how that worked for them and what the implications are for everyone else.
Well, so they they divested their bottling operations, so they've kind of separated their sort of marketing and their manufacturing, if you will, and that that has worked for them. That's a model that has worked for them. It reminds me a lot, actually, of the way McDonald's runs a different business, but
Right.
but people think of McDonald's as a restaurant company, but they're not really a restaurant company. They actually operate very few restaurants as a percent of their total network.
Yep.
They really are first and foremost a marketing company. They're a product development company, and I think the third thing I'd say is they're a real estate company, because their model is all about their marketing, their menu, and supporting their franchisees with those, and then being really sharp on location,
Yep.
which is critical for any retail business. And so Coca-Cola is also is basically outsourced the operational side of their business, and that works for them. The thing that's interesting in both cases is, to me at least, the central question in both cases is where and how is value added in this business for the consumer.
Yep.
And I think what they have shown in both cases is, in the case of Coke, manufacturing and distribution isn't where the central value add is. It's in product, it's in the secret formula, it's in the marketing, it's in the innovation and product development. And I think a similar case is true for McDonald's. Not that operating a restaurant isn't important, and they supply an operational model to their franchisees, but they basically said, hey, there's a lot of, that's a heavy balance sheet to own a whole bunch of restaurants, own a whole bunch of production and distribution assets. And so they're running a different model in it, and it works for them.
Yep. And it's one, I think, that's enticing because of the financial measures that kind of drive things that way. It's actually a burr in my saddle. Clayton Christensen actually talked about this in one of his books as well, about how our financial measures caused, for example, Dell to outsource and outsource and outsource to get manufacturing assets off their books.
Yeah.
But even if you do it and it's a positive, like it has been for Coke, you do introduce risk there as well. I mean, Coke and McDonald's both have to have consistent product that's high quality, and they don't necessarily control all those outlets.
That's true. But so here's what I'd say about there are many case studies in manufacturing of companies who have followed that financial bait and outsourced with bad outcomes. And I would argue the reason is because they simply followed financial bait.
Yeah.
What they didn't do is follow the consumer. And they didn't ask themselves, well, okay, like what are the assets that actually deliver value for our customer? And those are the ones that we need to control.
Mm-hmm.
We need to control those because that's how value gets added. And in some businesses, that value add is a very central part of the manufacturing of the product, and you just can't outsource it for a variety of reasons. And in other cases, there are companies who I think have looked at that and said, gee, we don't actually need to have all these assets to be, to really deliver the value.
Mm-hmm.
Now, to your point, if you've got a McDonald's franchisee who's not operating well, you have to have some hooks in that situation to go in and fix it, and McDonald's does.
Yep.
And similarly with Coke, if you've got a distributor who's not executing the way they need to or whatever, then you've got a problem. So it's not that you can just ignore that because you've outsourced it. But I think the error that you see in the cases that I have seen is that the decision is taken strictly through a financial lens, when in fact that is not the lens for the people who've done it successful.
Yep. Got it.
Yeah.
Yeah, and that's an interesting insight with that value add piece. I'll steal that with pride.
Yeah, I mean there are businesses at General Mills. General Mills, has a mix of company owned and contract manufacturing that you're very familiar with. And if you think about where the company outsources, I've worked on some of those businesses, and the value add for the consumer is not happening in the manufacturing facility.
Mm-hmm.
It's somewhere else. Often it's in the formulation, actually.
Yep.
It's often at the R&D bench is where that value add happens, and so you can use a mix of company owned and and contract, and do so quite successfully.
Yep. Just to throw a little challenge your way, I wanted to get your insight on a couple of companies I really admire, both of which I think have kind of done the impossible, looking at my manufacturing lens, and those are Chobani, which remains a standalone, and then Fairlife, which is part of that Coke story.
Yes, yeah, great, both great examples of innovation. I mean, and these are companies that that came into. I mean, think about those two categories. Both dairy categories, and they brought tremendous innovation, and and have been quite successful. I mean, they found a need, and very impressive in both cases what they've done. The Chobani case obviously is one that I'm very familiar with, and they have continued to. They really, have taken that brand, which was successful through yogurt, and they've now kind of said, okay, we've got a huge brand here. Where else can we take that brand, and have continued to grow, under the founder, which is another thing that's, a little bit unusual in this world right now is that kind of that continuation of the founder's leadership. More often what you see is a founder gets a business to a certain point and then just kind of needs to sort of turn it over to another leader who's going to take it to the next level. Or, they get to a point where they cash out and, somebody else buys the business, and Chobani really stands out in that regard.
Well, and Hamdi Ulukaya is a hero of mine for business and beyond.
It's very impressive.
Inspirational
very impressive
figure.
what he's done, for sure. Yeah.
Yep.
Yeah.
So let's go back to the basics then. The CPGs as a broad category, where should the business leaders be looking for growth?
Well, is this a kind of where is their growth in the market, or more of kind of how should they be thinking about kind of their own priorities?
I'm thinking more growth in the market. Where are the
Okay.
opportunities?
Well, I think the trends, the consumer trends that are out there have been out there for a while, and I don't fundamentally think there's a lot of new news there. There has definitely been a longstanding trend toward better for you products. Now, the meaning of better for you is, got a lot of nuance to it, but natural
Yeah.
organic is a space that's been growing for 40, 50 years, and has just accelerated as it's gotten more mainstream in the last, 20, I would say. So that continues to be a space for disruption and innovation. Snacking is another space that has very consistently been a growth space. And again, there's
Mhm.
lots of variations of snacking. Snacking right now seems to be having some headwinds. You're seeing just reports of a slowdown in the consumer behavior there. I'm not ready to buy that that's a permanent dynamic, just
Yeah.
because I mean, I think I was still at General Mills, so this has got to be. I mean, this is 10 or 12 years ago when snacking became the largest single meal occasion. Um, ahead
Yeah.
of the three traditional meals. Like, I mean, when I say the largest single, I mean like a majority, like over 50% of meal occasions were a snack.
Yeah.
And so I think that certainly will continue more broadly in food. Um, when one of the things that consumers do with increased food budgets as their household income increases is they they buy convenience, and they buy quality, and some of that is out of home. And so, the sort of the trend line of, more dollars kind of going to the sort of restaurant food service side of the business and less to in-home eating, that also generally, I think, is a trend going forward. And some of these trends get disrupted by economic disruption. And so the sort of current period of time can make it a little bit difficult to read, but I but those are all things that really have been very consistent for quite a long time now.
Yeah. Back on your snacking comment, I'm inclined to agree because in my long experience, it seems in America anyway, we like to talk a good game on eating healthy and not really behave that way.
And I can tell you, having done some work with clients in international markets, that's true in other places as well.
Mm. Okay.
Much more important to actually watch what the consumer does
Yep.
than to take to the bank what they say they do.
Yep.
That's
For
a, that's a
sure.
that's a marketing axiom for sure in this business.
Yep. Understood. Well, let's talk about McDonald's strategy partners. What is big for you now, and what are the opportunities down the road?
Well, I this is just been a great kind of third career for me. I love what I'm doing. I love helping leaders and teams really get tight on what their priorities are and clear on their strategies. And so we continue to do that. We are doing more and more work in the last few years with emerging brands in the CPG space, and we love that. We love that work. I mean, it's exciting to work with teams that are focused and hungry and winning, and to help them continue doing that. And so we'll continue to do that work. And then the other thing, though, that I've recently started doing, I'm working with a friend and former General Mills colleague, sort of doing what I would call focused strategy projects for bigger companies. A big company doesn't need my help putting their strategic plan together, but those plans are obviously more complicated because the companies are more complicated, and sometimes they need help with a particular project. And so we have, we've started to do a little bit of that kind of work, and that's really that's been kind of fun too. So, continuing to work in the industry and really enjoying it. Excited to continue.
Well, and I'm excited to have you continue. I learn something every time you throw anything out there. So I appreciate it.
Thank you. I appreciate it. Yeah.
Well, thank you for coming on, Peter. This has been incredibly enlightening, and we'll see how things progress going forward. So I love the CPG world, so I hope it improves.
Yeah, thanks, Jim. Great to spend time with you. I appreciate it.
Okay. Well, and of course, as always, thanks to you in the audience. You are why we're here. We're here every Tuesday, so tune in. We'll have another great show every Tuesday. Can't promise it's going to be as enlightening as what Peter brought, but they're all going to be at least a little enlightening. So from Jim Vinosky and Manufacturing Talks, thank you so much. Signing off. So long.
Thanks for tuning in to Manufacturing Talks with Jim Vinosky. Watch for new episodes dropping every Tuesday. And don't forget to like, share, comment, and subscribe.